So I think the first 6 months of 2025 will continue to see this bull market run. It's going to be largely dependent on what the Fed does. I do think that the Fed is probably going to cut one more time here in 2024 and then pause, unless the caveat there is obviously if we see the economic data deteriorate significantly, and if we started to see employment deteriorating here in the U.S. I think inflation is manageable where it's at. It's obviously not at the 2% target, but I think there's just not enough for the Fed to keep cutting after this. And so that's where I think you're going to see markets get a lot more volatile in the back half of the year. So really heading to 2025, not trying to time anything here, is just moving more defensively. We can't forget we're coming off of 2 years where equity markets are up over 20%. So that's obviously a great run. I know, the third year, 2022, was a negative year. So on a rolling standpoint, it's not as good. But when we're looking forward, valuations are somewhat stretched. Not enough for us to jump out of the market, but like I said, to move more defensively. So looking at higher dividend type paying stocks, I think is key here. Real high cash flow, real robust business models. So, it is not, the trade you're going to tell everybody about at your wine and cheese party, but it's the tried and true type names. I think when you're looking at something like a Eli Lilly that's sold off over the last few months, or even on the tech side to look at Google or Alphabet. Obviously, there's been some breakthroughs in the last couple weeks, but generally speaking, it had lag. So I think, that is a business model that, once again, it's not a high-flying, high-beta type name relative to some of the stuff you see in AI, but it's something you can kind of count on if we do start to see volatility pick up. And if markets keep running, those are the type of names that run with them. The bigger trade for us still is on the fixed income side. You cannot ignore the fact that high-grade bonds are yielding in the highest level they have in over a decade. Obviously, we've seen yields come down quite a bit, but still very, very attractive. For me, it is the most asymmetric from a risk to reward standpoint when you're looking at, okay, what are the possibilities of rates really going up much more from here? Pretty low. If rates stay where they're at, I'm happy to clip this coupon. And if we start to see rates come down, obviously the price appreciation of those bonds would be welcomed. And so that right there is our highest conviction trade. Like I said, I know once again, it is not one of those type of stories that gets people excited. When you're talking about bonds, I can put enough people to sleep with talking about yields and complexity. But at the end of the day, like I said, I have to look at risk to reward, the asymmetry. And anytime I see something that is this skewed, it has to be a top of mind trade for us.
Adam, don't underestimate our viewers. They'd be interested in bonds. And if it's the only game in town, then it's the only game in town.